Well, I think we can go ahead and get started here. It's 1 p.m. Central Time. And hello, everyone, and welcome to today's Trustee University session, Premium Finance and Trust Administration. Really appreciate everybody taking the time to join us today and hope everybody is staying safe with all the weather and cold that's going around. And hopefully your Wi-Fi stays up. But a little background on Trustee University. This was created by ITM and Life Insurance Trust Company, two of the leaders in life insurance trust administration. ITM provides ILET administration, policy review services, and management, and really just helping trustees stay compliant and efficient. And Life Insurance Trust Company is that first corporate trustee focused solely on ILETs, diving into deep expertise in trust management and regulation. So together through Trustee University, they share insights, best practices, data-driven trends to help professionals deliver smarter, more effective trust planning and client services. Now, when we move over to the next slide there, Shandy, again, my name is Aaron Hansen. I'm the Director of Remediation with ITM, and I'd like to welcome our guest speaker, Michael Moore. A little background on Michael. Yeah, he began his career in the financial services industry back in '96, and his background in insurance comes from a combination of asset retention and tax mitigation planning for individuals and businesses. Now, utilizing a safe, low-risk insurance products, Michael assists clients in pre- and post-retirement planning, as well as estate transfer to future generations. He's been a licensed life insurance agent in the state of California since 2000 and holds licenses in more than a dozen states while earning the Chartered Financial Consultant and the Chartered Life Underwriter designations through the American College. Currently, Michael works as a Vice President of Sales and Business Development for Everbank's Life Insurance Finance Department. With Everbank, he helps to manage and oversee a billion-dollar loan portfolio, working with advisors to place large insurance policies on ultra-high net worth clients. He currently lives in Laguna Niguel, California, with his beautiful wife, Alicia, and their two children, Abigail and Max. And before I hand it over to him, just a few housekeeping reminders and announcements that I'd like to touch on here. There will be a post-event survey. Thank you in advance for completing. So within 24 hours, you'll get an email with a link to this recorded event. And today's session will be approximately 50 minutes or so. We'll try to leave some time at the end for any questions. So please do submit any of those questions in the portal. If we run out of time and we're not able to get to those questions, we will follow up with you after the session here. So with that said, I'm going to hand this over to you, Michael, to take the floor. And very good.
Fantastic. Thanks, Aaron. And thank you, Shandy and Litco and ITM for having me here today. It's an honor and a pleasure to speak with you all and everybody out there in the virtual world. Thanks for taking time out of your schedules to come in here today. So today we're going to talk about premium financing, how kind of a high level overview of what that is, life insurance premium financing, the trustees' responsibilities and that kind of thing, the risks, why a corporate trustee matters, and then, like Aaron said, we should have some time at the end for some Q&A. Let's go to the next slide. This is my elevator speech when people ask me, what is financed life insurance and why do people do it? Well, life insurance premium financing allows these ultra high net worth clients to get the valuable valuable insurance that they need with little impact to current cash flow or investments. And that's very important for the high net worth clients because most of them are not, they're not trust fund babies. A lot of them are not lottery winners. These are people that, built brick and mortar with their hands from the ground up. They've created this wealth and they want to leave as much as they can for, their heirs and future generations. And a lot of them, especially small business owners, want to put as much money as they can back into their empire and keep making it bigger. And so finance life insurance is really perfect for these people. It's not for everybody. Obviously, we throw around the word ultra high net worth a lot. That depending on who you talk to and the various insurance companies, banks, these people are typically going to be 15, 25 million net worth and up. Next slide. Premium financing 101. We'll just jump right into it. This is going to be a 10,000 foot overview. If you have questions, please, like Aaron said, please feel free to launch those out here to us. This is strategy to fund large life insurance premiums. If you got to buy, if you're worth $100 million dollars and you need $50 million dollars of insurance for estate tax, for equality of inheritance, for state estate taxes, those premiums could be, multiple millions of dollars. And so clients would rather put up a little bit of collateral, borrow the money from a bank, pay interest versus those larger premiums, and get that insurance that they need. And then down the road, that you could discuss exit strategies. It could be death, it could be an asset sale, could be a combination of some of the cash value buildup inside the insurance policy and some assets from the client. But really, it's just a strategy to get these large life insurance policies, get them inside of a trust, make it tax efficient, and have that money available for whatever the original planning was for. It's very common in estate planning, and because when you're planning for the estate taxes, you want these things inside of a trust. And so once you have a trust, there's certain things you have to navigate, and that's why using and why I like to partner with Litgo and ITM is using a very good trust management company who understands not only the life insurance products but also the how the financing works. This is going to be coordinated with an insurance advisor, a financial advisor, an attorney, a CPA, and then for smart people, I would say a corporate trustee. Next. So who's this for? We kind of touched on it. These are high net worth individuals and families, business owners, C-suite executives. If you start thinking about doing planning for retirement income, they call them LIRP, life insurance retirement plans, down the road, can be a very effective way to help them get large policies with little impact today, like I was saying. Next. Why do clients premium finance? Well, first off, they may be illiquid. We deal with a lot of farmers, a lot of real estate people, and not always necessarily illiquid, but they like to say what I like to say is keep their powder dry. They want to have that liquidity sitting on the sideline for that next big deal that comes along. So they preserve their liquidity. And we'll talk about instead of paying large life insurance premiums, these clients write checks for a smaller interest payment. These are interest only loans typically. And so the savings of paying that smaller interest payment versus that larger premium payment is what we dubbed retained capital. And just a quick example, if my premium is $100,000 a year, and I can write a check to the insurance company for $100,000, or I can borrow the $100,000 from a bank and write a check to the bank for $5,000 of interest at a 5% interest rate. You can avoid asset sales and taxes. A lot of people don't have $1 million, $100,000, $500,000 lying around. And if you got to go into your portfolio and sell some of your stock or a piece of real estate, you're obviously going to pay taxes on those. You can improve your gifting efficiency. With a $19,000 current annual exemption, depending on how many beneficiaries you have and how many people are grantors of the trust, you can oftentimes get the interest payments into the trust without tapping into the lifetime exemption. And a lot of people like that, especially attorneys, because they like to leave that lifetime exemption for doing other planning on the side. So that's one thing to think about. And then these are clients that understand leverage and arbitrage, right? I talked about it. It's a lot of real estate people, hedge fund guys, family offices. And so they understand leverage and arbitrage. If the clients don't like debt, then this is not really a play for them. But a lot of high net worth clients have borrowed money, so they understand it. Next slide. Well, why do we use a trust? The trust allows the insurance policy to be removed from their estate, which then makes it not that makes the government not be able to get it for the estate taxes, right? So it doesn't if you own a life insurance policy outright in your estate and you die, that is now includable in your estate and subject to the taxes, versus having the insurance policy owned by the trust. Um, the trust is the beneficiary. Then, when the life insurance policy comes to fruition, the money is paid into the trust. There are no taxes there, and then that money can be used to pay the taxes for the estate. Clients can control distributions. I talk to a lot of clients about, making decisions from the grave, right? So your trust, you set it up and you can dictate, your client that your children, your heirs are going to get portions of money at certain time frames or when they hit certain milestones, graduate from college, start your own business or certain ages just so that they don't get a massive amount of money at one time. The trusts are creditor protected, and in some states you have some anonymity, and you can kind of keep your name out of the papers and your family's name out of the papers. And trusts are great for generational planning. A lot of these clients, they have kids, they love their kids, but their grandchildren are the ones that they really want to take care of. And when you have generational wealth like that, you're not planning for second generation. It's the third, fourth, and fifth that they like to think about going forward. Next slide, please. The common trust structures, I'd say number one is an irrevocable life insurance trust, or as we call in the old insurance business, an ILIT. But we do see quite a bit of spousal lifetime access trusts, generation skipping trusts, dynasty trusts. They all do little different things, but the main factor that they all have is that these are outside of your estate and creditor protected, and very good about being there once the insurance payment comes due and needs to be paid out. Next. So we'll show a little graphic after this, but basically a client will apply for a life insurance policy, and at the same time, they'll apply for a commercial loan from a bank. And the client's going to pay interest and post collateral to the bank. The bank's going to send the premium to the life insurance company. The company pledges the life insurance policy back to the bank so that in the event of an early death, the loan is repaid and the balance of whatever insurance is left after loan repayment goes to the trust, and the trust can send it out to the heirs. Now, it doesn't always have to be loan. It doesn't have to be loan repayment at death. I think I mentioned it earlier. We use cash value building products like Whole Life and Index UL. So there could be an opportunity to use some of the cash value to repay the lender. Typically, what we see is the client has an asset sale or some sort of financial event, and they can use some of that money or some of the cash value to repay the lender, and then you've got a larger life insurance policy if you're not going to use the death proceeds to repay the lender. Next slide, please. So here's what it looks like. This is what I said. So you're going to set up a trust or a corporation. Doesn't always have to be that way. In the case of an estate planning, you're typically going to use a trust, and the client's going to gift or loan those interest payments to the trust, and the trust is going to pay those interest payments and post that collateral to the lender. The lender is going to send the premiums one way, and then at death, the insurance company will pay off the lender and send the balance of the proceeds to the trust. Then the trust distributes out to the beneficiaries. So what I tell a lot of people is it's not a very complicated transaction. If you've done trust-owned life insurance, you've sold, trusts to clients in the past, the only little extra piece here is instead of using the client's money to fund the premiums, you're getting a third-party lender. A lot of people, if you've been around the business a long time, you remember the old split dollar thing or private financing. It would be the same thing. Instead of the lender, you would have private wealth money or the family's money to borrow from and split dollar. Next. Well, there are risks in anything, especially when you're borrowing money. And I think that we've lived through some pretty risky premium finance times here in the last 3 to 4 years with, an interest rate spike that went up almost 500 basis points and shocked a lot of people. So a lot of these things, a lot of the success on premium financing depends on uh, structuring it properly and letting the clients know what are those risks and let's make sure that they are prepared for it just in case it happens. These last few years, I've seen interest rates go from 3 to 8%. A lot of clients were caught by surprise by that. It increases your interest payments, it increases your collateral, and so you really have to set the tone up front for them so that they understand, hey, here's what we need to be careful of. And the first thing I always tell clients is your financial health is the most important thing in these transactions. Because if you file bankruptcy, there's absolutely nothing that we can do. The bank will call the loan. They will expect repayment within 30 to 45 days. And if you can't do that, they're going to surrender the policy, take the cash value, and then whatever the gap collateral is that the client had to put up, they're going to take that. So, I tell clients, listen, we're doing this so that you can keep your money at work for you. And so make sure that you are still doing what it is that you do and do it well. Um, Policy return risk, this comes with more of the Index Universal Life type insurance policies. You're going to have a floor of zero typically and a cap of, somewhere between 9 and 12%. And so if the policy doesn't perform, then you may have to put up a little more collateral. You may have to push out, if you're going to use cash values to repay the lender, you may have to push out the the date that you're going to pay that off, which means maybe I've got to keep paying a little more interest. So the return risk is also there. Insurance carrier solvency, we don't really worry about too much anymore. Most of the insurance companies that we do are they're always A rated or higher. And as so we keep an eye on that. But if an insurance company, becomes insolvent, then it's just something you have to think about. It's not one of the larger risks that come up very much, but you still need to have that conversation. Interest rate risk is probably the number one. If you are not paying any interest, because you can certainly, for the ultra high net worth, they sometimes would just like to finance the thing at 100% and not pay any interest and just put up the collateral. When interest rates skyrocketed like they did these last 4 years, the collateral became somewhat of a burden too. So interest rate risk and your collateral risk, I would say, go hand in hand. If you're not paying all the interest. If you're paying all the interest, it's just a matter of, okay, well, my out of pocket went up. But I think when you still compare the IRRs on financing a policy, paying interest versus premiums, even with interest rate increases like we've seen here recently, these still make it still makes a great deal of sense. The lender appetite is another one. You know, I can tell you because I've worked at two banks now for premium financing, and then on my own as well, working with several other lenders. They love these loans, and they love it more than real estate. And the reason I say that is you have basically, AAA type paper on life insurance carrier cash surrender value. And the difference between what the client has borrowed in principal and interest and the cash value is that gap collateral that they have to put up. So if my premium's $100,000 and I've got $50,000 of cash surrender value, the client has to personally post $50,000 of what we call gap collateral. And so these lenders and these loans are 100% secure at all times. So they love these loans. I don't worry about lender appetite too much anymore. It was more about the client's appetite when interest rates went from 5 to 8, 3 to 8. So next slide, please. The types of risk, interest rate risk is fixed versus variable. Fixed rates right now, they're still being offered. Nobody's really looking at them because it seems like interest rates have come back on a downward trend. But variable rates typically reset either every 30 days or every year. And so that's just something you have to be cognizant of. Your collateral risk, like I said, you have the opportunity cost of using cash collateral, versus a letter of credit or a Schwab account or some sort of stock market account. You have your market volatility. So if you're pledging a stock account and market goes down, they could ask for more of your stock portfolio. Same thing with margin calls. We talked about that policy performance risk. First, it needs to be properly funded, right? So, and typically, what most of these are, how most of these are funded is upfront. You typically not financing a premium that's going to be paid, 15, 20, 25, 30 years. You're typically going to try and fund these and get as much money into the policy to let it go to work so that you can start knocking down your collateral. They're typically funded between 5 and 10 years. So it needs to be properly funded. It needs to be properly structured, that you've got enough premium in there, that you have stress tested not only the policy but the interest rates, that you've shown the client, what happens to your collateral account in the case of an underperformance. And then every once in a while, we do see insurance companies. It's very difficult for them too, but they will occasionally, you'll see them on a class of business increase their COIs if they can't pull any other levers. That's an unfortunate thing. What you have to hope there is that, your client is still, insurable and can look at maybe 1035 exchange of cash surrender values to a new or better product. I will say that all of these risks here, a lot of them are watched and mitigated by what Litgo and ITM do. They're keeping an eye on these things for you every year. Aaron talked about, he runs the remediation department there, and when they see something that looks like it's going the wrong way, Aaron and his team look at all those options and provide them to you to try and help your client make the right decision about moving forward. We talked about the solvency risk for the insurance company and the lender appetite. Unless interest rates drop way back down to, the ones and twos, which I don't think, I'm not sure we'll ever get back to that. They would look for better returns on different asset classes. But for the most part, this is what we have conversations with every client. Aaron, do you have something to add?
Yeah, I guess want to go to the next slide there when we dive into the trustee responsibilities. When we look at that, Shandy, next
Okay.
slide. Yeah, when we get into the administration and the policy review side of things, um, often the biggest challenge is just getting the background on, what's going on, what the plan is it still on track? Often these policies, or most of the policies that we see, were done pre-Litco becoming involved, or ITM. So we're building that file and trying to get all the right parties in line and making sure communication is going. But when we look at the active administration overall, it's similar to a standard policy in a sense, with the Crummeys and the policy reviews. But where it differs, and a lot of what Michael's spoke on here is getting into the collateral aspect, or the interest payments, and how that policy is performing. So when we start to look at that, normally we'd be sending out a gift notice, what we call that request for a premium payment on a policy. That would normally be going out 60 days in advance. And Michael, you can jump in on this, but I think most often those lenders are not releasing the funds for the premium payments until it's much closer to that due date. So it's a matter of making sure that we understand, or that you understand, the timeline as it's involved, in any requirements that lender, or collateral requirements that are involved there, and ensuring that premium payment and those funds get routed to the carrier, in a timely fashion.
Yeah, that's correct. And I'll say this, If you've never done a premium finance case before, seek out what I will call a third party administrator for premium finance. There are lots of them out there. There's some good and some bad, but obviously, I think if you've never done it, there's a lot to navigate. So I would always say look for them. And I will tell you that as a lender, we typically start our underwriting process, just like Aaron said, about 60, between 45 and 60 days out. We start requesting in-force illustrations from the insurance company. We look at the collateral portfolio and what it's done and where it is, based on the original conversation of, are you paying interest? Are you capitalizing interest? Are you paying down principal? What are the different things that you're doing? That all happens 45 days prior to when the premium is actually due. So there's some time there that, the Crummies can be prepared. You can have these conversations with the client about what we want to do moving forward. And so it's not going to be a rushed process. So financial oversight, fiduciary discipline, family dynamics is one that, working with LICO and ITM, a lot of people want to name their brother-in-law, their uncle, their best friend as a trustee. And the problem with that, in my opinion, is that they're too close to the family. And you have these family dynamics that pop up, and somebody passes away and people get emotional, and they start. You don't want family members to become enemies of each other because money makes people do strange things. So having a corporate trustee in there that doesn't have an emotional role into this thing. They're not tied to people or money that's in the trust. They're there to just basically carry out the wishes of the grantor and the way that the trust was written. So I can't stress this enough. It's boggling to me sometimes how many high net worth clients that are willing to write a check for $100,000 in interest don't want to write a check for $1,500 for a corporate trustee. But I would tell you, you need to have that conversation with the attorney, the CPA, the client, and say, you know what, we're all going to be better off if you do it with a corporate trustee. I think we can go to the next slide, Shandy. You want to take this one, Aaron?
Yeah, so diving back into the trustee responsibilities and even taking a step back and when you talk about a corporate trustee and the differences, and not to get lost in the weeds, but everything that we have built from an administration or a policy review standpoint has systematic steps in place, triggers in place every year, things that can fall or catch before they fall through the cracks. It's something that you see when, someone that only manages, one or two trustee or a family member, this is just kind of talking about why you need an experienced corporate trustee in place. But, we talked about when we look at, this slide here and just looking at the Crummey letters and interest payments, when you get into the policy management aspect of it from just say a review point of view, one of the biggest challenges that we see may be getting an illustration from a carrier that reflects what's going on. So that's when we talk about having that open line of communication with the lender, or with the advisor that's um, navigating that premium finance arrangement. It's important that you're all in unison on getting the information and getting that properly into the system. So one, you as trustee and our named administrator have a true, accurate understanding of what the plan is. And when you get into managing family objectives, like we see day in and day out, some families involved, some is not. Um, for the most part, making sure that everybody's on the same page. And as you've seen with the interest rates rising, Michael, you had mentioned that that changes drastically in some cases how that policy is going to perform, and if interest payments or collateral payments or principal payments are not resuming, is that because it's a decision? Is that because it's someone not paying attention or not really looking long term and what that looks like? just making sure that everybody's aware of how that looks 5 years, 10 years, 20 years down the road, when it comes to, the different requirements there.
Yeah, that's true. And like I said, it goes back to, having the proper and correct trustee and working with somebody who knows how to navigate the premium finance marketplace, because they're going to be an aid for, companies like Litgo and ITM as well when they have a hard time getting the story, I guess, from either the insurance company or the clients. But you
And
know,
Michael, real quick, when you get into collateral management, um, often that's a letter that a trustee or a requirement that a trustee will receive from the lender. Can you dive in a little bit on, what that process looks like, in terms of when that's presented to a client? Is it generally 30 days before or during that underwriting when you're looking at it 45 days before that upcoming due date or that premium due date? Is that generally what that would look like for a trustee's perspective?
that's correct. That 45 to 60 days out, that they are running the in-force illustrations so they can see where is the policy cash value currently. Then they look and see what is being held as collateral. Is it cash in a money market account? Is it a CD? Is it another insurance policy? Is it a brokerage account? And they make their determinations on how they look forward at collateral. And then they would ask the client to add additional collateral or not, depends on what happened, in the past year, which is why they do the review. And if the client needs to put up some additional collateral, that needs to be done before they will fund that next year premium. So, yeah, then banks are pretty good about it. I know we are very good at that. And the collateral is probably the one piece that most clients have the biggest heartburn with. So we really try and get ahead of that and make them feel comfortable about it. This goes back to where I said, Aaron, on the front end is really setting their expectations of what could happen and running them stressed models that show, hey, look, if interest rates go from 6 to 8, or policy, we projected it to perform at 6 and it only performed at 4. The dividend scale was supposed to be 575 and it really came back at 5.25. Clients need to understand that those are the moving parts that affect their collateral management. The policies, this stuff's all kind of like what we just talked about. And then, managing the family objectives, that's where a good trustee can come in and say, I have no skin in this game except to do what the grantor and the trust asked of this thing to do. And so, I talk about the family dynamic a lot. I think a lot of us, and advisors on here would probably agree with me. We're part salespeople, we're part insurance, or if you're a financial advisor, we're also part psychologists at times. And having a trustee, corporate trustee like Litgo and ITM, I think makes a huge difference. Having the right bank, having the right CPA, all of those things kind of melt together. The next slide. Well, I think we probably already talked about all this, Aaron, but we'll just hammer it home. Uh, having that deep understanding of the life insurance product and how it works is tantamount. Loans are loans. We've all bought cars. We all have bought houses. We understand typically how loans work. I borrow money, I pay interest and some principal, and somewhere down the road, I will have hopefully paid this thing off. So, you know, understanding the life insurance policy, understanding the trust and the trust mechanics and the things that you do and you don't do to make sure that you're not, you know, pulling anything back into the estate, that you're not violating any trust laws or any of that kind of thing. I really want to make this about having the right trustee, and these are all the things that you really need to think about when you do these large transactions. So having that expertise, that impartial decision making, that they're not, like I said, they're not part of the family or part of any of the gains to be had on these things. Um, the regulatory compliance, we talked about Crummey's, And most people, a Crummey is basically a gift to the trust that the beneficiary of the trust have to say, I'm not taking that gift because I understand that it's being used to service debt, pay interest, used as collateral, because I know that the end goal is for ultimately to me to get the life insurance proceeds that I can use to keep mom and dad's legacy alive, keep the business going, pay the estate taxes, not have to sell off, our homes or ranches or whatever it is. So, efficiency, it's just so much easier with a corporate trustee. Plus, you have that perpetuity. I've seen people that named a relative as a trustee, and they predeceased the grantor, and nobody ever did anything with it. Well, if you don't have your trustees not alive, the trust is not being monitored correctly or serviced correctly. Stability across generations. That's what I was talking about. The perpetuity and risk management. That's Litgo's a fiduciary trust company, so they have to do right. They're bound by not only a code but laws and all those kinds of things.
Yeah, Michael, just diving back into a few of these, when we talk about, and you don't have to list out all the products, but from your experience, um, what products are generally preferred when you start to get into this type of arrangement, premium finance arrangement? Is it generally a variable policy or is it an index? I know you mentioned whole life, but maybe just dive in a little bit on those products that you see most often here and why.
Sure. So most products are going to be some sort of cash value building type product. You won't see a lot of guaranteed universal life or what I like to call term to 100. It doesn't build up any cash value. The cash value in these transactions is typically going to be the majority of the collateral. So, 15 years ago, the product of choice was whole life. And simply because you have guarantees on the death benefit and the cash value, but you have a little slower growth. About 10, 15 years ago, index universal life became very popular because you have the upside potential with a cap, but you still have a zero floor, so you can't technically lose any money. I would say today, the marketplace, no variable, by the way. Thanks, Aaron, for bringing that up. You can't finance variable policies. There's SEC rules against a bank lending money to. It's a Reg D issue. So it's usually going to be a current assumption UL, an index UL, or whole life. I would say the market right now is probably 90% IUL and 10% whole life. That being said, I have seen I want to say, not a return to normalcy, but a little bit of a sway back the other way to the whole life simply for those guarantees. It takes a lot of that question of, well, what about my collateral? What if the policy doesn't perform? Um, so you can't lose money on an IUL with a 0% floor. If you bought a product that has additional riders that give you some sort of bonus and there's a charge to that. Now, obviously, if you get a zero one year, you still have fees, your cost of insurance, your fees in there, premium taxes, all those kinds of things. Those will still come out. So, can your cash value go down? Absolutely. But you're not technically losing money because it didn't perform. You have that 0% floor, so it should like be a backstop almost at that point. I hope that answers that question. Sorry, I had my Q&A box open, Aaron. I just saw that thing pop up.
Yep, you're good.
Yep. So, like I said, a lot of we've seen a lot more whole life lately. That doesn't help when interest rates spike, obviously, but it clients that want that peace of mind of knowing that I'm going to get a guaranteed deal in here. Yeah, maybe not. Thanks for that. Next slide.
One of the challenges, real quick, on the index products that we have seen over the years is, the limits on the hypothetical illustration rate, the AG 49 rule that's out that limits that hypothetical return. So I know that's a challenge, and that's probably a challenge that you see often with a lot of the premium finance deals that you see. But I think it just, it's something to keep an eye on and definitely monitor and make sure that you have somebody in place that understands that aspect of the index product.
Agreed. And AG 49 was definitely a good thing. It took away people, showing outrage. It reminded me when I got into this business, variable life was really the hot thing, and you could show 18, 22% returns, and they at one point finally put a damper on that. I look at AG 49 rates. We show the client that. We show them, maybe 100 or 200 basis points below AG 49. You can't show anything above AG 49 because people get angry about that, and really, the software won't let you typically with these. So, it's show them the AG 49, show them something a little less than AG 49. You should be technically, cover yourself. I've seen certain insurance companies that, they can run you some theoretical models where it'll run it above AG 49, but they throw a 0% return in there every 3 or 4 or 5 years, which gets it back down to what the AG 49 is. So you can see the power of that. IUL is always, zero's your hero. And so, it's all about that front end planning. So, it can be a powerful strategy. And again, I'll go back. I reiterate, it's not for everyone. This is for high net worth clients that understand risk, understand leverage and arbitrage, probably have a better use for their money, but know and understand that they need this life insurance. Life insurance is a very powerful tool for wealth transfer. Um, and so it requires a lot of that oversight to be managed properly. And we talked about the whole team, the CPA, the attorney, the trustee, the financial advisor, the premium finance company, the lender. It really needs to be managed, and have good people looking at it. And like I said, I would absolutely say a corporate trustee is recommended. These are complex transactions. I shouldn't say that. I said it wasn't too complex. I mean, it's obviously there's another level of complexity by having the loan involved. And so having a corporate trustee, I would just highly recommend it.
Sure. One question that has come up in the past and that we see often is, do you find it more, I guess, common that the loaning or the total loan that's in the policy over the years is repaid by the death benefit? Because obviously I can see how that would be desired. You can see how it would be, or do you see at a certain point, say 15 years or 20 years down, that a withdrawal is taken from the cash value of the policy to repay, and then the policy continues on with that loan satisfied? I don't know
I
if you
think a
see.
lot I think a lot of people, Aaron, like the idea of using the policy's cash value to repay the lender.
Mhm.
It doesn't always happen that way. I think, these are typically 15 to 20-year strategies. You got to get the money in there, you got to let it bake a little bit, and something happens down the road. It could be, like I said, an asset sale, a transfer. The cash value did build up the way they wanted, but you know, it never. I think you start out with this idea and something happens down the road that the client says, you know what, I'm just going to take out the loan, myself, or we're going to do an asset sale or a sale to a defective try. There's so many things that you could do, but it, I would say you're going to be in it for 15 to 20 years, and the client's going to have a lot of life changes during that time. Could even be, you know what, we've done so much planning, we've gotten everything out of our state, we don't even need the insurance policy anymore. We need very little death benefit of this, and so then it makes it easy to drop death benefits, maximize cash, use the cash to get out of the policy. One of the things I know that Aaron, is life settlements as well, which is another way that if things get a little squirrely, there's always an option for the older clientele to offload these policies to an investor. Next slide. Oh, there we go. Questions. Look at that. Just about 45 minutes, Aaron. We're pretty good
Wow,
at this.
nice work. Well, I appreciate you going through that, Michael. And I know premium finance and this side is it's unknown or a mystery to many corporate trustees and administrators, and something that we see often now uh, as we grow with LITCO and ITM. So we're learning every day more and more. And in general, you think you haven't seen something, you'll see something new
That's
as soon as
true.
you think it's coming. But I appreciate your time, and I think we've answered the questions that have come in, or that you answered there, primarily around the index product. Um, but if
Yep.
anybody, after this session is done, you think of something, definitely reach out, send an email. Michael, being the expert, will definitely get back to you. But if you have questions about Litco or ITM in general, do reach out, give me a call. Happy to discuss and answer any questions there.
Absolutely. And I can tell you just from our experience, Aaron and I have collaborated on a couple of cases, and I'm open to helping them and any of you out there for sure. So thanks again, Aaron, for having me.
You bet. Thanks, Michael. And thanks, everybody. Stay warm.
Yep. Bye bye.
Right.